Raj says, could you... Oh, okay. Well, I'm sorry, Raj. He says, bought a long time ago. Can you let me know how I can use power options to manage these horrible leap positions? The stock is NNDM. First, let's just build one or two of these positions. I can't. I think you have two separate positions here. Okay, 19th of January, 2024, 5 strike puts. Okay, so you do have two separate calendars here. January 2024, excuse me. 5 strike puts. And sold 5 contracts at 447 of the 10. Okay, so these are bear put debit spreads? Okay. All right, so 5 strike puts here, bought 20 contracts. Okay. And then, oh, I'm sorry, the 7.5 put, sold 5 contracts there at a different price. And then sold 10 contracts of the 10 strike, all January 2024. Oh, and then 12.5 put. Okay. All right. Let's start from scratch. Bought 20 at 220. Sold 5. No. My apologies. Yeah, sold 5 for 447. Sold 10 at 612. And sold 10 at 860. Okay. All right. So we've got 25 short, 20 bought. Stock is down well below the sold put strike prices. And yeah, we're in this structure where the loss, I mean, doesn't look that, oh, okay. Yeah, it doesn't look that bad. I know it's a loss, but monetarily, it doesn't look that bad. Rather than analyzing this as a seat position, so right now, let me take a look back at the pricing. 203 to 238. Okay, I'd say this one right now, almost, Raj, leave alone. Okay, this one's kind of doing what you want. The stock is still falling, excuse me. You paid 224 at midpoint, as roughly around the same, close to it. So right now, if you're still bearish on the position, leave that alone. I would personally analyze each one of these legs as an individual naked put position. Rather than looking at it as some kind of four-legged spread and tracking it in power options, it's going to appear as a custom spread. You're not going to see any position analysis. What I would do is put these in as an individual legs and see what rollout opportunities are available. So let's go ahead and it doesn't matter which portfolio we do. Let's just go into May 20th. And okay, let's go ahead and naked put. Oh, sorry, short put. My apologies. An NDM. And I'm not going to say I'm going to cheat, but I'm going to cheat first, and I'm just going to use the 5 contracts of the 7.5 put first. Oh, sorry, folks. All right, and we sold 5. Date doesn't matter, and we collected a premium of 447. Okay, for this 7.5 strike put, January 2024 on NNDM. Should have just put this individual. Where is it? Oh, there it is. See, this loss isn't too bad in this scenario. I mean, in this position, this one's okay looking, right? You're trying. I think you were trying to hedge the loss, hoping the stock would come back up. And as it kept going down, you chased down to these lower strike puts. What I would have preferred to see you do is manage if you started out selling the 12.5 strike put for 860, which I don't know if you did, but it's really difficult to knock down losing on this position, which you're not losing that much on at all. It's only a loss of 2.1% for these 5 contracts. Buyback cost, of course, is 2,313, so you're taking a small loss there. But let's just even see if we go to position actions and position analysis, Raj. There are some rollout opportunities here. Oh, it's saying you could convert it to a covered call. Okay. But I think there might even be opportunities to roll this down. So I don't see anything here. So let's go to what if calculations. Even staying in the same month, which I don't know if is the best idea. But in this position, you're not losing much. You're not behind much at all. Any stabilization or move back up, you could start seeing movements back into this position. So let's just go through it. What would the buyback cost be again? We said 463. And I mean, I could even go down and sell the 250 in this case. Now, it might not be the target return you're looking for, Raj. But again, we know where we are now. We're at a small loss here. You roll down to the 2.5. You're taking the loss here of that 19 cents or so, 16 cents, my apologies. And you can sell the 250. Not too far out of the money, but 56 cents. So that's going to put you positive $200 or a 19.3% yield as long as this stock continues to stay above 250. There's always room for more downside, of course, but that's what we have to look at in those cases. So let's just add the bigger one in quickly. We might not see any management techniques for that. I'm sorry. So let's add another short put in. And we'll take the NNDM, and I'm going to have to see all options, of course. And the 12.5 put for 860, right? Was that what you put in? No. Sorry, I think, oh, there it is. I'm sorry, folks, I lost it. Yeah, 860. Okay. Where are we on the NNDM 12.5? Your loss of $130 are down 10.4%. And let's just check position analysis again. It might show me the covered call idea. Nope, no rollout opportunities. But similar situation. You're not that far behind. Yes, you're 130 behind. But if we go back into the position now, we can't roll further out in time. But maybe this one's... Oh, I put in 1. I'm sorry. This was the one that was 10, wasn't it? That's a much higher loss. I'm sorry. So you're seeing a much higher loss. I apologize for that. That was 10 contracts. Okay. No, sorry. Okay, sorry, folks. 10. Let's get that right. All right, so it's $9.90. So we're losing $1.30. Oh, it added twice. Why did it do that? Okay, there we go. Sell 10 at 860. I'm sorry. Now, we buy it back here. That's what I was trying to illustrate. We buy back the $12.50 now for its current price. You saw the loss that we were taking, okay? So it's $9.90, so we are at a loss now of about $1,300. You've got 10 contracts. Now, there's not much in the 130 range that I saw, but even rolling it down to the 4 strike, if you're still bullish on this position, if you think the stock's going to recover over time, this could put you in another positive range, similar to what we just saw with the 7.5 strike. But I'm paying for it here. Yeah, it's only a 6% return, but it's now $225. But again, still need the stock to move up to 4 in these scenarios. Yes, you're seeing losses on your positions due to the contract size, 10 strikes and 10 strikes. You're seeing losses of $1,300 and whatever it was on that first one. It was relatively low in that case. 130, right? Oh, no, this was 1,300. This 5 contracts is a loss of $78 or 2.1%. That's not that bad. If NMDM comes back up a little bit, this might even start showing a profit. I don't know the stock, and I'm not going to give any recommendations on if it's going to move or not in those cases. But that's what we're taking a look at there as well. It's not too bad a position. You could consider rolling down, as I mentioned, to the lower strike prices there. Get a better structure, not the return maybe you were hoping for on this stock. But again, treat them separately. I would treat those 3 initial, let's get back to our original view here. That's not it. There we go. Treat these three in the power options portfolio as individual naked put positions rather than part of a larger spread. And this position, it's kind of doing what you want right now as a hedge, but it's also kind of doing what you want. It's at a small loss right now, but it's been moving down. So that's going your direction. Management here, yes, it's all part of a larger spread. I understand that, Raj, but rather than complicating it, look at the rollout opportunities as individual naked put positions, and then you might be able to compare what the new position would be look like against your 20 contracts with a price of 220. You would want to make sure that the total net credit that you still have rolling down these positions is in the realm of that cost basis of $4,400 that you had for that long option, so that you sort of have a lower exposure with the kind of spread structure you'd be creating, which this one might be below, as we saw your long put strike price. You'd have a bear put debit spread with 5 of those contracts, and then you'd also have bull puts on this side. But what was the goal here? The goal here looks like what you were doing is selling puts and then trying to manage by selling more puts as the stock continued to fall. Might have been better just to adjust the put as need be, or you're trying to do a bull put credit spread out in time. And again, the losses are piling up and you're seeing big numbers, but they're not too far off individually. Rather, looking at the whole trade itself, each individual leg, this is down $1,300, yes, but it's $1.30 per contract. That's not too terrible. And this one we saw was only down about 16 cents per contract. That's not too terrible and could be managed depending on what your outlook is for NNDM. You still have 588 days to go as well, Raj. So let's consider that also. Action might not need to be taken immediately in these scenarios, but for power options, tools to help, as I mentioned, put those legs into the portfolio as individual naked puts, see what adjustments might be there, or do the manual adjustments as I walk through about maybe rolling them down, evaluating what loss would be with the buyback cost of that existing option, and then what it would look like going forward.